Most people think they're struggling financially because they don't make enough money. But what if that's not the real problem? What if hundreds or even thousands of dollars are quietly leaving your bank account every year through spending habits that feel completely normal? In this video, we're breaking down 3 things people waste money on and still defend. From food delivery apps to extended warranties and constantly upgrading to the newest smartphone. These aren't obvious financial mistakes. They're the kind of habits millions of Americans justify every day without realizing how much they're costing them in the long run. And more importantly, I'll show you exactly how to fix each one with practical steps you can start using today. By the end of this video, you may find a simple way to keep more of your money and put it toward building real wealth instead. Number 1. Food delivery apps. Uber Eats, DoorDash, Grubhub. Have you ever opened DoorDash because you were tired after work? Most Americans have. The problem isn't ordering food once in a while. The problem is when convenience quietly becomes a habit. A burger that costs $12 at the restaurant can easily turn into a $22 to $28 purchase after delivery fees, service fees, taxes, and tips. That's not just paying for food anymore. That's paying a premium for convenience. And here's what makes it dangerous. Most people don't feel the pain because the extra charges are spread across dozens of small orders throughout the month. One delivery order doesn't seem like a big deal, but 3 orders per week can easily cost $200 to $400 more per month compared to picking up food yourself or cooking at home. That's thousands of dollars per year. The real issue isn't the food. It's the habit of solving every inconvenience by spending more money. Many Americans say, "I'm too busy, I'm exhausted, I deserve it after a long day." And sometimes that's true. But if every stressful day leads to a delivery order, the habit slowly starts competing with your savings goals, emergency fund, debt payoff plan, and investment contributions. Convenience is valuable, but when convenience becomes automatic, it often becomes expensive. The people who build wealth aren't necessarily making more money. They're usually more intentional about where their money goes. And that's why this matters. Because small daily spending habits often have a bigger impact on your finances than the occasional large purchase. The goal is not to completely eliminate food delivery. The goal is to stop paying premium prices when you don't actually need to. Start by identifying your biggest trigger. For most people, it's one of these 3 things: lack of time, lack of energy, or lack of a plan. Most delivery orders happen because dinner wasn't planned. So instead of relying on willpower, build a simple system. For example, keep 3 to 5 easy meals in your house at all times. Things like rotisserie chicken, frozen vegetables, rice, pasta, eggs, sandwich ingredients. Nothing fancy, just food you can prepare in 10 to 15 minutes. Another strategy is creating a monthly convenience budget. Instead of ordering whenever you feel like it, decide in advance, "I'm allowing myself 2 delivery meals this month." Now you're making a conscious decision instead of an emotional one. Also, if you're already picking up groceries or running errands, consider picking up restaurant food yourself. A 5-minute stop can save you $10 to $20 per order. That may not sound life-changing, but investing an extra $200 per month into an index fund instead of delivery fees can potentially become tens of thousands of dollars over time. The point isn't deprivation. The point is making sure you're paying for convenience when it actually improves your life, not when it's simply replacing a little planning. Convenience should be an occasional tool, not a daily financial habit. Here's a simple challenge. Open your bank account or credit card statement right now. Look at the last 30 days. Add up every dollar spent on DoorDash, Uber Eats, Grubhub, or restaurant delivery services. Don't estimate. Calculate the actual number. Many people are shocked when they discover they've spent $100, $200, or even $500 plus in a single month. Next, choose one simple rule. Cut your delivery orders in half for the next 30 days. Not eliminate, just cut them in half.
Then automatically move the money you save into your emergency fund, retirement account, brokerage account, or debt payoff plan. This creates a direct connection between spending less and building wealth. The biggest lesson is simple. Most people think they're buying food. What they're really buying is convenience, and convenience becomes expensive when it's purchased repeatedly. If you use delivery services intentionally, they're a useful tool. If you use them automatically, they can quietly drain thousands of dollars from your future. Small spending habits rarely feel important today, but over the next 10 years, they often matter more than the big financial decisions people obsess over.
Before we continue the video, here's a quick reminder. Like, comment, and subscribe, and turn on the bell icon. Number 2. Extended warranties. You're standing at the checkout counter. You finally buy a new TV, laptop, refrigerator, or washing machine. Then comes the question, would you like to add the extended warranty? Suddenly, you're being told that if something goes wrong, this warranty could save you hundreds or even thousands of dollars. Sounds responsible, right? Not always. The biggest problem with extended warranties is that they're usually sold using fear rather than probability.
The salesperson wants you thinking about the one worst-case scenario where your product breaks. What they don't emphasize is how rarely that scenario actually happens. There's a reason retailers push warranties so aggressively. For many stores, warranty plans generate significantly higher profit margins than the products themselves. If extended warranties were consistently great deals for consumers, companies wouldn't make so much money selling them. Another issue is coverage limitations. Many people assume the warranty covers everything. Then something breaks and they discover certain parts aren't covered, accidental damage isn't included, claim approval takes time, repairs require specific service providers. Some situations fall under exclusions hidden in the fine print. The result? Many consumers pay for protection they never use. And even when they need it, the experience isn't always as simple as they expected. Here's what makes this financially important. Imagine spending $150 on a TV warranty, $200 on an appliance warranty, $100 on a laptop warranty, $250 on another protection plan. Individually, those purchases don't seem huge, but over several years, many households spend hundreds or even thousands of dollars on warranties they never claim. That's money that could have been growing in a savings account, invested for retirement, or used to pay down debt. The real financial question isn't, what if my product breaks? The better question is, how often do products actually break, and is this warranty worth the cost? That's the question most consumers never stop to ask. The solution isn't to automatically reject every warranty. The solution is to become your own insurance company for small purchases. Before buying any extended warranty, ask yourself one question. If this product broke tomorrow, could I afford to replace or repair it? If the answer is yes, you probably don't need the warranty. For most household electronics and appliances, a better strategy is creating a small repair and replacement fund. Instead of paying warranty companies every time you buy something, put that money into a savings account. For example, if you skip a $150 TV warranty, a $120 laptop warranty, and a $200 appliance warranty, you now have $470 in your own repair fund. Keep doing this over the years, and you'll often have enough money to cover the occasional repair yourself. Another thing many Americans overlook is the protection they already have. Some credit cards provide extended manufacturer warranty coverage, purchase protection, damage protection, theft protection. Many people pay for extra coverage without realizing they already have some. Always check your credit card benefits before purchasing another warranty. There are a few exceptions. An extended warranty may make sense when the repair cost would be extremely high, the product has a documented history of reliability issues, the terms are unusually strong and transparent, you genuinely cannot absorb the financial risk. But those situations are less common than salespeople would have you believe. The goal isn't to avoid risk completely. The goal is to pay for protection that statistically benefits the seller more than it benefits you. Financially successful people don't insure every inconvenience. They save money so they can handle inconveniences themselves. That's a very different mindset. Today, take 5 minutes and do a quick financial audit. Think about the last few years. How many extended warranties have you purchased? Now ask yourself, how many of those warranties did I actually use? Be honest. Most people quickly realize they've spent hundreds of dollars on protection plans that never delivered any value. Next, create a simple rule for future purchases.
Never buy an extended warranty on the spot. When the salesperson asks, simply say, "I'll think about it." Then go home and evaluate the decision without pressure. This one habit alone can save you from countless impulse purchases. Even better, start a dedicated repair and replacement fund this week. Set up an automatic transfer of $25 per month, $50 per month, or whatever fits your budget. Over time, you'll build your own financial cushion for unexpected repairs. Instead of hoping a warranty company approves your claim, you'll have cash available when something breaks. That's real financial flexibility. Here's the biggest lesson. A warranty doesn't eliminate risk. It transfers risk for a price. And in many cases, that price is higher than the risk itself. Companies sell extended warranties because they're profitable. Consumers build wealth by being selective about which risks are worth paying someone else to take. The goal isn't to avoid every possible problem. The goal is to become financially strong enough to handle most problems yourself. That's what financial security actually looks like. Number 3, buying flagship phones every 1 to 2 years. Every year, a new phone arrives. A better camera, a slightly faster processor, a brighter screen, a few new AI features, and suddenly millions of Americans start thinking, maybe it's time for an upgrade. The problem isn't buying a good smartphone. The problem is replacing a perfectly functional phone long before it's actually worn out. Modern smartphones are incredibly powerful. For most people, a phone that is 2, 3, or even 4 years old can still handle calls, texts, social media, banking, streaming, email, photos, navigation. Yet many consumers upgrade because they want the newest device, not because they truly need it. And that's where the financial cost starts adding up. A flagship phone in the United States can easily cost $1,000 to $1,500 or more. The monthly payment may only look like $30 to $60 per month, but that's exactly why it's dangerous. When a large purchase is divided into small monthly payments, it feels affordable, even when it's not. Many people aren't evaluating the true cost, they're evaluating the monthly cost. That's a huge difference. Another issue is the upgrade cycle itself. Phone companies and carriers often encourage consumers to trade in devices every year or two. The message is simple. Why keep your old phone when you can have the newest one? But financially, frequent upgrades create a never-ending payment cycle. The phone gets replaced before you fully maximize its value, and instead of owning technology for years, you're constantly financing the next version. Here's why this matters. Imagine someone upgrades every 2 years and spends an average of $1,200 each time. Over 10 years, that's roughly $6,000 spent on smartphones. If that same money had been invested instead, it could potentially grow into a much larger amount over time. The real question isn't, can I afford the monthly payment? The better question is, am I replacing this phone because it's broken or because something newer exists? Those are two very different reasons, and one of them is far more expensive than people realize. The solution isn't to stop buying smartphones. The solution is to maximize the value of the phone you already own. Most people don't need the newest phone. They need their current phone to work better. Before upgrading, ask yourself, Is my phone actually limiting my life, or am I just tempted by new features? For most Americans, the answer is surprisingly simple. The phone still works. The battery may be weaker, storage may be full, performance may feel slower, but those problems are often fixable. Before spending $1,200 on a replacement, consider replacing the battery, clearing unused apps, removing old photos and videos, updating software, and resetting the device if necessary. A battery replacement costing $80 to $120 can sometimes make a phone feel new again. That's a lot cheaper than buying another flagship device. Another smart strategy is creating a personal upgrade rule. For example, keep every smartphone for at least 4 to 5 years unless it becomes unusable. This forces you to focus on value instead of marketing. It also dramatically reduces technology spending over time. And if you truly need a new phone, consider buying last year's model, a refurbished device, a certified pre-owned phone. Many of these options offer nearly identical performance at a significantly lower price. Remember, the newest phone usually provides a small improvement. The biggest financial gains come from avoiding unnecessary upgrades. Technology companies make money when you upgrade often. You build wealth when you upgrade intentionally. That's the difference. Today, look at the phone you're holding right now. Ask yourself one honest question. If a new version of this phone didn't exist, would I still feel the need to replace it? For many people, the answer is no. That's an important realization. The urge to upgrade is often driven by marketing, comparison, and excitement, not necessity. Now, calculate something simple. How much would your next phone upgrade cost? Let's say it's $1,200. Instead of upgrading immediately, imagine investing that money. Even a single delayed upgrade can free up hundreds or thousands of dollars for your emergency fund, retirement savings, index fund investing, paying off high-interest debt. Next, create a personal rule. Never upgrade your phone because you're excited. Upgrade because you have a real need. That one rule can save an incredible amount of money over your lifetime. Also, remember this. A smartphone is a tool. It's not an investment, it's not a status symbol, and it's certainly not a wealth-building asset. The goal isn't to own the newest technology. The goal is to get the maximum value from the technology you already paid for. Here's the biggest lesson. Wealthy people focus on value. Consumers often focus on novelty. Those two mindsets lead to very different financial outcomes. A newer phone may feel exciting for a few weeks, but keeping an extra $1,000 invested and working for your future can benefit you for decades. Don't replace something that's still serving you well. Replace it when it no longer serves its purpose. That's how financially disciplined people think. The truth is, most financial mistakes don't come from one giant purchase. They come from small spending habits repeated over and over again. Whether it's food delivery apps, extended warranties, or upgrading smartphones too often, the common theme is the same. People often spend money to solve short-term problems while creating long-term financial ones. The good news? You don't need a higher income to fix these habits. You simply need more intentional spending. Because every dollar you don't waste today is a dollar that can help build your future tomorrow. Spend with purpose, save with discipline, invest with patience. That's how real wealth is built in America.
That's it for today's video. If you enjoyed it, don't forget to like, comment, and subscribe. See you in the next Smart Money video.